Hi everyone, welcome to today's video. So let me start today's video by asking you a very simple question. This question is one of the most popular questions on social media. So I thought that I'll share it with all of you and take your response on this. So the question is that why do you think that in India we don't get entrepreneurs like Elon Musk, Steve Jobs, Jeff Bezos, Richard Branson? What is the single biggest reason for that? Now, there are multiple reasons that you can think of, but my answer would go something like this, that if you actually check when did India get independence, it got independence on 15th August 1947, right? So 75 years. Now, if you compare when did the US get independence, it was back in 1776. So, US has been a free country for almost 250 years now. So, US approximately has a 170-year lead on us. Now, you might say that, hey Akshat, what difference does it make, like 170 years? Because Mukesh Ambani is from same generation. Jeff Bezos is also from the same generation. So, how does it create any impact? It creates a lot of impact because the entire ecosystem that is supporting people like Jeff Bezos, Elon Musk, that ecosystem has been there. You might have heard of the story that how Steve Jobs actually called up the CEO of one of the biggest companies in the world and he asked him to give him computer spare parts. From that, he developed computer. The same story goes for Bill Gates, that the school in which he studied, that actually had a computer lab. And it was one of the earliest schools in the world to have a computer lab in place. So all these ecosystem benefits accrue if your country has been free and it has been investing a lot of money in developing that basic infrastructure. Now, of course, there are multiple counter arguments that I will end up reading in the comment section. But the message is very simple, that India is a new, free, independent country. And going forward, it's only a matter of time that we will start exhibiting more and more growth. I have talked about this on some of my earlier videos also, that India is set to witness one of its bull runs. It's only a matter of time when that will happen. We have great demographic dividends. Our growth rate had been good up until 2020. It's not as if that there are any fundamental issues with India. Our internet infrastructure is in a good place. We are seeing so many unicorns being developed over time, which validates that India is actually a booming market and there is a lot of potential in the Indian economy. Now, if you invest your money in a booming economy, it is obvious, it is absolutely obvious that you will end up becoming rich, right? It's plain and simple. There is no math that is required there. That is generally how countries become rich. You might again have heard of the China's economic story. A lot of middle class people in China became really rich. Why? Because China as an entire economy grew a lot. So this video is dedicated towards me discussing a very simple strategy. Even if you don't understand investing, you don't know much about investing, but if you believe in the narrative that hey, India is likely to grow in the future, how you should go and invest your money in a very simple manner. So I'm going to discuss something called as passive mutual funds on today's video. That is what the entire video is dedicated about, and we are going to discuss four things. First, we are going to discuss the difference between active and passive mutual funds. Two, we are going to take a deeper look at passive mutual funds and why investing in passive mutual funds is a sensible decision for beginners. Then I will show you how you can make investments in passive mutual funds. And finally, I am going to discuss that how did I used to make investments back in my 20s. Please stay till the end of the video if you're someone who is doing SIP or are interested in investing in mutual funds, be it active mutual funds or passive mutual funds. Listen to all the points because this video can help you save a lot of money in the long term. And thanks to our knowledge partners, Navi Mutual Fund, for this video, I'm going to show you how their mutual fund is actually a great instrument for beginners to invest and save. So first and foremost, let us understand the basic differences between active and passive mutual funds, and I'll not bore you. I'll explain it in a very easy to understand language. So look at this picture. This must be flashing in front of your screen, and it says that Indian equity hybrid mutual funds have the highest expense ratio in the world. Now, every month, I'm sure that many of you would be doing SIPs in a range of mutual funds, right? Be it like large cap, mid cap, small cap. And if it is falling in one of those mutual funds that are pure equity, you might be paying a lot of commissions. You would not even realize it, but the money is going out of your pocket just in terms of commissions. Take a look at another picture here and it outlines the total expense ratio that you end up incurring, right? So TER stands for total expense ratio. And for AUMs means asset under management. So if a large mutual fund house has only 500 crores under asset under management, then you might be paying up to 2.25% TER for that equity fund, right? I have refrained from naming specific companies, but the picture is very clear, and this is the key takeaway, that if you're doing SIPs in mutual funds, what type? We will discuss that in a minute. But if you're doing SIPs in mutual funds, you might be paying a lot of TER, that is total expense ratio. So please be wary of what expense ratios are, how much commissions you are paying out every month, because if you just go and blindly invest your money in mutual funds, you might end up losing a lot of money, literally losing a lot of money. So please be very cognizant of the total commissions that you are paying. So let me explain very briefly the difference between active mutual funds and passive mutual funds. So active mutual funds basically means that there is a mutual fund manager. He has his team, he has his office, that office has AC, fans, whatnot. And that team, that entire team is picking up your money. So you're giving that team 10,000 rupees a month, hypothetically speaking. They take your money and then they actively manage that pool of money, right? So there will be hundreds, thousands of people like you who would be doing SIPs for that actively managed mutual fund and giving that actively managed mutual fund that money. They take that money, then they start trading in the equity or debt market, right? So whatever the underlying assets are, they pick your money. So they buy and sell securities in that space. So that is called as actively managed mutual fund because the activity is more, so to say. Okay, now let's understand that what are passive mutual funds. Now compared to active mutual funds, passive mutual funds are less actively managed. So let me help you understand this via an example. So let's say that you go and invest your money in a Nifty 50 index mutual fund, which is a passive mutual fund. So don't worry about the name. We will understand that better. But let's say that you go and invest your money in a Nifty 50 index fund. This is a type of a passively managed mutual fund. Now, would this fund have a mutual fund manager? Yes, they will have a mutual fund manager. It's not as if that passively managed mutual funds do not have a mutual fund manager. That mutual fund manager will have a smaller team. Why? This is something that you need to understand, because when we are looking at Nifty 50 or Sensex based mutual funds, that bouquet or portfolio of investments is limited. When you're looking at Nifty 50 mutual fund, it's very, very simple that the mutual fund manager will take your money. If you're paying him 10,000 rupees, he'll pick that money and whatever the Nifty 50 that month indicates, he or she will go and buy that Nifty 50 stocks on your behalf, and it's done. So the mutual fund team does not have to engage in a lot of headache in terms of research, orientation, whatnot, right? So therefore the work gets reduced. Therefore your commissions charged are much lower. Now an obvious question here would be that, hey Akshat, would passive mutual funds not give lower returns compared to actively managed mutual funds? Because here we have a team, they are doing research, they are doing a bunch of different things. So my assessment is that these people might be generating more returns compared to passively managed mutual funds. The answer might surprise you that when it comes to passively managed index mutual funds, the returns historically have been much higher. Just to give you an estimate that the last 20 years Nifty 50 average has been around 12.2%. Large cap actively managed mutual fund, it has been between 8.5% to 11%. Now there are many reasons why this is happening, so we'll not get into that. Bottom line, if you're a new investor, then the data tells us that you must go and invest your money in a Nifty 50 index mutual fund or a Sensex mutual fund, because these are passively managed, so they will have lower commissions. Second, their historic returns have been high. So hopefully that would continue. Now Mr. Warren Buffett has a very interesting story around this. Now few years back, he actually made a bet. He made an open bet. He said that, hey, if any mutual fund manager can beat the index return, then I will give him X dollars. I don't recall what that X dollars were, but he said that. And no mutual fund manager was able to beat him on that bet. So that is what the power of passively managed mutual funds are, and you must strongly consider passively managed mutual fund if you are a beginner in the mutual fund investing space. So this brings us to part 2, where I'll just quickly outline that what are the primary benefits of investing in passively managed mutual funds. So essentially there are 3 key benefits. Number 1 is the simplicity. So every month you're not wondering that, hey, where my money is going, because when you go and give your money to an actively managed mutual fund, they will say that we are going to invest your money in mid cap, large cap, small cap stocks. You would not know what specifically those stocks would be. So that's a headache, right? Especially when you don't know where your money is going. But if you are investing your money in a passively managed index fund, then you know that your money is going to either get invested in Nifty 50 stocks or Sensex stocks. Done, right? You are picking the best Nifty 50 companies if you are investing your money via Nifty 50 mutual. This level of simplicity is very high when you are investing via Nifty 50 mutual funds. If you go into active mutual funds and if you want to make investments in active mutual funds, which mutual fund should I pick? Should I pick large cap, small cap, mid cap, debt, equity? There are so many mutual funds that you will get confused, right? So if you're a beginner, just make your life simple. Go and invest in a Nifty 50 mutual fund. The returns have been historically anyways better compared to large cap equity funds. Number 2, there is something called as entry and exit loads. Entry load means that in order to invest in that mutual fund, the mutual fund manager or his team is going to charge you a little bit of money. So that is entry load. Similarly, exit means that when you're selling off your mutual funds, you will have to pay the mutual fund the money to get out of that mutual fund. Now, generally speaking, Nifty 50 passive mutual funds do not have this problem. So the entry and exit loads are very less or nil. Third point is total expense ratio is very low for passively managed mutual funds. Total expense ratio, as I had shown you from one of the earlier slides, I'll put it here again, that the total expense ratio on actively managed mutual funds, especially hybrid and equity funds, is very high, right? So please keep that in mind. Now you might say that, hey Akshat, do Nifty 50 passively managed mutual funds, do they have any expense ratio? The answer is yes, they would have it, but the expense ratio will be very less. For example, you can check that Navi Nifty 50 index fund expense ratio is 0.06%, which is minuscule. So please check exit, entry, load, expense ratios and then go with a particular mutual fund. Now let me show you how you can easily invest in Nifty 50 mutual fund. Now in order to invest in a Nifty 50 mutual fund, you can go to Navi mutual fund. Press the invest now button. They have low fees and their management team is really good. For example, if you read about them, then Sachin Bansal backed Navi Technology, plans on making financial services simple. So we all know who Sachin Bansal is. So that is a great value add with Navi mutual funds. So you go press the invest now button. Now whichever company you have your trading account with, for example, if you're using Zerodha, then you can use Coin by Zerodha, which is the mutual fund investing service of Zerodha. So you simply click there and start investing in Nifty 50 mutual fund. Now this brings us to the final section of the video, that how did I used to invest when I was in my 20s. So my strategy was really off when I started investing. I used to invest in actively managed mutual funds, and surprisingly, I did not even know the difference between passive and actively managed mutual funds. My mutual fund agent used to come to my house. He used to show me a wide range of options that, hey, this fund has given like 15% return in the past. It used to entice me and I used to invest my money in it. That was a problem, right? So over time, I started losing a lot of money. That made me realize that I have to learn how to manage my own money. I started reading about a lot of things, right? Direct equity investment, investing in passively managed mutual funds. Even today, I invest in passive mutual funds, right? If I'm picking up mutual fund investments, I would make majority of my investments in Nifty 50 or Sensex backed mutual funds only. Because of the expense ratio, entry exit load, simplicity of investments. If I don't know where the market is going, if I have no clue that, okay, you know what, it just looks dicey, I need more time to analyze things, then I would simply put my money in Nifty 50 mutual funds. So in passing, if you want to invest in India's growth and if you don't have time to do equity analysis, then the simplest strategy is that you go and invest your money via passively managed mutual funds. It can help you save a lot of money in the long term. It can still help you benefit from India's growth, and in the process, it will make you rich. So I hope you enjoyed the video. Give it a thumbs up and I'll see you the next time. I would reiterate that mutual fund investments are subject to market risks. Read all scheme related documents carefully and only then consider making investments.